Google just announced earnings. This is the press release. Please pay attention to this because Microsoft just announced and it wasn't good. They missed and they're down after hours. So let's go look at Google in our Everything Money software. And of course, if you belong to the software, follow along. Okay, after hours, it missed on revenue and EPS, but it's up after hours. That's a lot different than Microsoft. Microsoft missed on revenue and EPS and they're down after hours. So guys, look at Google. Remember, Google just had a 20-for-1 stock split. It hit a high of 151 in the last year and a low of 101. And it's currently at 108. So it's 7% higher from its low. Now, let's go look at this press release first. This is off their website. So they did revenue of 69.685. They were estimated to do 69.95. So they missed by 300 million, but it was still up 13% year over year. They expected EPS of $1.29, but they only got $1.21. Their profit was very small, up very low amount. Look at that. And look at their operating margin, 28% versus 31%. So lower operating margin. Okay, is this a good thing? No, it's not. But if you're new to the channel, I want you to remember, I don't worry about analyst expectations and short-term gyrations in earnings. Go look at a company like Berkshire Hathaway. Their earnings are going to fluctuate like crazy. You've got to remember that our goal as investors is to pick a great company, separate it from the stock, value the stock, and buy it for a discount of that value. That is our goal. It requires patience. Patience can be boring, but you know what's not boring? Making a lot of money. You know it sucks? Losing money because you overpaid because you were too excited to buy a stock because you love the company. Just be patient. You see this fluctuation over the last year on Google. A high of 151 and a low of 101. That's 33% loss in the biggest advertising company in the world. All right, so let's go take a look at their 8 pillars. For those of you who are new to this, I'm Paul. I'm a value investor. Like I said, I use my 8 pillars as a screening process. And then I use our famous stock analyzer tool to make assumptions about the company and see what I need to pay for the stock based on those assumptions. And we'll get to that before the end of the video. So first off, 8 pillars. And just like the Microsoft video. So guys, 2 X's here. High on the 5-year PE, high on the 5-year price to free cash flow. Now, that doesn't mean you avoid the company. If a company is growing 100% a year, I will gladly pay 35 times free cash flow if it's going to grow 100% a year for the next 10 years. But Google's large, so it's probably going to slow down its growth as time goes on. And because of that, it might be harder to justify this 35 price to free cash flow and 33 PE ratio, right? Okay, that's fine. But look at other attributes of the company. 5-year average free cash flow of $40 billion, and last year they did $70 billion in free cash flow. That is incredible. High return on invested capital, 13.6%. No dividend. Gross margin, 57%. Gross margin of 57%. That is incredible, guys. This company prints money, and when they bring more money in, it goes right to the bottom line. I think something like 97 or 98% of their revenue comes from their advertising business. However, they have other parts of Google where they're building things up and trying to generate more revenue and grow their other companies into bigger companies, okay? So Google, definitely an active company. All right, so let's take a look at their cash flow. I just want to show you guys their cash flow the last 5 years because it's truly impressive. On our cash flow statement, we added the free cash flow line, 21, 25, 29, 50, $69 billion in free cash flow. All of this over the last 5 years. So even though the average is 40, you can justify putting that higher number in there, right? Look what it was 10 years ago, 12 billion. They're over 5 times more from 12 years ago, 5.5 times more from 10 years ago. That's an incredible, incredible, incredible number. Let's see what's going on in the news for Google. YouTube TV's 5 million viewers hold a lot of value for Google's future. That's awesome. Russia fines Google $34 million for breaching competition rules. $34 million. That's adorable. Oh, God. How Warren Buffett quietly invested. I didn't know that. Okay. So I do believe I first heard about Google in 2002 from a friend of mine. He said, there's a great website. It's called Googl. Have not switched since. It's only become you are here on YouTube. The 2 largest search engines in the world are Google and YouTube, and they're both owned by the same company. This is an incredible advertising source. They make tons of money off advertising. At some point in this video, you were interrupted for that. So let's go to our stock analyzer tool and now figure out what we want to pay for Googl. Now, like usual, I use 10 years of analysis, and we start with the revenue growth, then input our profit margin numbers, free cash flow margin, PE, price of free cash flow, and desired return. All right, so in the last 10 years, their revenue growth has increased. 21% over the last 10 years, 23% over the last 5, 37% over the last year. So you're probably thinking, oh my God, this is getting faster. But guys, it's a huge company. Last year, it did $270 billion in revenue. If that were to grow at 12% per year for the next 10 years, that would make it $838 billion in revenue in the next 10 years. Possible? Sure. Probable? I don't know. But remember, my goal is to be conservative. So for revenue growth assumptions, let's go by stock analyzer. I'm going to go with 5, 8, and 11. Profit margin. Again, increasing profit margin. I'm going to go with 23, 24, and 25. And the reason I didn't go to 27, and that was only 1 year of profit margin this high. So I'm going to pump the brakes. We already see a decrease in the margin in this last quarter. Free cash flow margin. I'm going to do 22, 23, and 24. PE, 14, 16, 18. 14, 16, and 18 for price of free cash flow. Now, you might say to me, Paul, what the heck? It's already at 18. Why are you sticking with 18 on your high? Because as it gets larger and larger, it's harder and harder to get growth. And PE, I think, should be driven by growth numbers. The faster it can grow, the higher the PE. And finally, for my desired annual return, I'm at 12.5%. Now, guys, if you watch our videos, you'll see me do different numbers in here all the time. The key is to be somewhat consistent and be around the same numbers. You don't see me going for revenue growth 10, 13, and 16. I might do 3, 6, and 9, or 4, 7, and 10, or something like that. But I'm probably not doing much different than this. All right? So the stock's currently at 105. Actually, 107.50. After hours. Hit the analyze button. Scroll down here. All right. So if you believe all the high assumptions, there's 11% revenue growth, 120s all day. If you like the low assumptions, 60. So it's got to fall 40%. Somewhere in the middle is about $90. So guys, add this to your watch list at $90. Maybe make it $100. Notify me. It'll email you, notify you. Thanks very much, guys. Don't forget to subscribe to our channel.